I don't see how First Republic opens as First Republic on Monday morning.
First Republic Bank has been taken over by federal regulators and sold to JP Morgan Chase.
Amidst the chaos caused by the First Republic Bank collapse, there were hints of a much larger problem lurking in the shadows. As the dust clears, experts have connected the dots and uncovered a web of economic warning signs that may foretell disaster for the nation. Join us as we break down the implications of this monumental event and explore the underlying factors that could trigger a widespread recession.
But the big question is, what happens next if another financial institution runs into trouble?
The current state of San Francisco's First Republic Bank is causing concern among the public, especially after the recent collapse of Santa Clara's Silicon Valley Bank. While it may look dark, it is important to remember that bank deposits are insured by the federal government for up to $250,000, which should provide customers with some reassurance. However, it is essential to note that the repercussions of this banking crisis could potentially seep into the economy and have a lasting impact far beyond individual savings accounts. If the crisis continues to spread, it could lead to an increase in the difficulty of acquiring loans and a rise in unemployment rates. In addition, it could potentially trigger a recession in the country's economic system. It is crucial for people to be aware of this reality and to take proactive measures to safeguard themselves and their finances against potential economic fallout. Established in 1985, the First Republic emerged as a distinguished banking institution that had its presence in 11 states across the United States, including the prosperous regions of California, Florida, Massachusetts, and New York. With an extensive range of financial products and services, the bank and its subsidiaries offered all-encompassing solutions to its customers, including personalized banking options, business banking, real estate lending, and premium wealth management services. In 2007, the First Republic was acquired by Merrill Lynch, an investment banking giant, for a whopping sum of $1.8 billion. Later, Bank of America acquired Merrill Lynch, leading to First Republic's ownership transfer to Bank of America. However, in 2010, Bank of America decided to sell First Republic Bank to private investors, eventually bringing the bank back into publicly traded companies. Throughout its history, First Republic has been defined by its adaptability and resilience in various transitions. Despite the changes in ownership and management, the bank has centered its business around its clients and their needs. The strides taken by First Republic Bank contribute to making it an influential institution that continues to shape and transform the banking industry. In a significant blow to the financial sector, First Republic Bank, one of the largest banks in the United States, was declared insolvent and sold to JP Morgan Chase by the Federal Deposit Insurance Corporation. This marks a major turning point in the current period of uncertainty and turmoil that has already claimed several small and mid-sized banks, following Silicon Valley Bank's failure in March. Moreover, the move is added to the intensifying fears of a deepening economic crisis and a severe credit crunch in the banking industry. The downfall of First Republic Bank signals a major systemic risk to the U.S. financial system, as analysts predict that additional banks may be heading towards a similar fate. The alarming impact of precarious decisions made by a single banking institution on the entire financial system has been highlighted by the recent collapse of Silicon Valley Bank and the subsequent downfall of First Republic Bank. This disastrous occurrence has brought to light a persistent systemic issue that the banking industry has been grappling with since the savings and loan crisis of the 80s. The root of the problem lies in the incentive structures that stimulate banks to take unacceptable levels of risk in their quest for profits. The current crisis is a grim reminder of the insufferable consequences of incentivizing banks to prioritize short-term gains over the long-term health of the financial system. The perverse incentive structures prevalent in the banking industry have resulted in a myopic focus on immediate rewards at the cost of irresponsible, ill-considered financial decisions that eventually hurt the entire system. These incentive structures have been the downfall of many financial institutions over the years, from the savings and loan crisis to the global financial crisis, and now the recent catastrophe triggered by the collapse of Silicon Valley Bank. Moreover, the aftermath of this most recent banking failure has highlighted the dire need for policymakers and regulators to take swift and decisive action to address the underlying issue. Banks must take action to reduce the risk to the financial system that is inherent in their current incentive structures. Please take a moment to hit that like and subscribe button if you are enjoying the video so far. The lack of appropriate oversight mechanisms has enabled a culture of excessive risk-taking in the banking industry. The stability and resilience of the financial system have been compromised as a result, which has worsened the impact of crises like this one caused by the collapse of Silicon Valley Bank. The banking industry faced a precarious situation as several regional banks, including Silicon Valley Bank and Signature Bank, faced failures. This caused widespread panic among clients, leading to a significant loss of deposits for First Republic Bank. The bank's earnings report revealed a staggering loss of $100 billion in deposits during the first quarter of 2023, primarily attributed to panic-driven withdrawals. The bank had already been struggling due to its large book of single-family mortgages that were issued at lower rates, resulting in billions in unrealized losses. And despite receiving a $30 billion infusion from 11 major U.S. banks, including J.P. Morgan Chase, Citigroup, Bank of America, and Wells Fargo, First Republic's deposits still dropped by more than 40% to $104.5 billion, reflecting a substantial decline in investor confidence. These developments highlight the fragility of the banking industry and the pressing need for regulatory reform to mitigate systemic risks and ensure financial stability. Do you know what happens when a bank fails? A financial institution sometimes finds itself in circumstances where it becomes bankrupt, which results in it being unable to cover its obligations to customers and creditors. When such a predicament arises, the bank becomes insolvent. When a bank is deficient, the Federal Deposit Insurance Corporation, FDIC, a government organization created to protect depositors' interests, intervenes and can either sell the bank to another financial institution or liquidate it entirely. Should a stable and well-capitalized financial entity purchase the insolvent bank, accounts belonging to all insured depositors instantly become accounts of the acquiring bank, and depositors have continued access to their funds as before. Alternatively, if the failed bank is dissolved, the FDIC will hurriedly commence issuing checks to depositors for the value of their insured deposits, which usually takes just a few days to process, ensuring that those affected do not suffer undue hardship or financial loss as a consequence of their bank's failure. Such prompt actions are necessary to reassure citizens that their financial investments are protected and that the government is always ready to intervene in a banking crisis. If you have deposited your money in a bank supported by the Federal Deposit Insurance Corporation, you can rest assured that your funds are protected as long as they fall within the FDIC guidelines and limits. The FDIC, a governmental institution, offers deposit insurance coverage of up to $250,000 per depositor. It is important to note that the FDIC only insures deposits, not investments in stocks, bonds, or mutual funds. In the event of a bank's failure or inability to meet the financial demands of its clients, the FDIC takes over as the receiver and ensures that all the insured deposits are repaid to the depositors. However, it is rare for the FDIC to cover deposits that exceed its limits. This unprecedented move, where the FDIC took on all deposits from banks such as SVB and Signature Bank, regardless of the amount exceeding the insurance limit, demonstrated the commitment of the FDIC to safeguard the interests of the depositors. It is crucial to note that the FDIC did not only take on the insured amounts, but also the excess deposits, which is a testimony to its ability to address unexpected financial crises. Moreover, the success of this move protected the bank's depositors and helped maintain public trust in the banking system, which is vital to the economy's growth. Therefore, it is prudent to invest in FDIC-insured banks to protect your deposits and safeguard your financial stability, particularly during uncertain economic times. But how can this entire situation bring an economic recession? When banks become insolvent and are taken over by the FDIC, It directly impacts economic growth. When the FDIC takes control of a bank, the funds become unavailable for lending and other economic activities. This can lead to reduced consumer spending, decreased business investments, and an overall decrease in economic activity. Ultimately, it can result in an economic slowdown and potentially lead to a recession. Furthermore, the bank's staff is likely to be laid off as a result, resulting in increased unemployment and a more significant decrease in economic activity. The resulting economic instability can also reduce consumer confidence in the stock market, which can further worsen the situation. It is essential to place deposits in FDIC-insured banks to protect depositors and the economy's health. By doing so, depositors can be confident that their funds are secure, and if a bank should fail, the economy will not be significantly affected. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.